If you want to be a smarter investor, you're in the right place. Today we're highlighting 7 of our favorite investing tips, courtesy of Charlie Biello at Creative Planning. Let's get right into it. Focus on saving before investing. Investment returns get all the attention, but for most people, how much they save is much more important than how much returns they generate, because most people don't save very much at all. Without savings, you can't invest. And that's true whether you're making 50 grand a year or $5 million a year. If you spend everything you make, there's nothing left to invest. So over 30 years, saving 10% of your income with a 1% of return easily beats a 10% rate of return if you're saving 1%. The most important thing that matters to you in your life is the percentage of income that you're able to save. Start off with that. Once you nail that, then focus on your rate of return. What's great about this is that saving more is something that's within your control. So start with that, focus on that, and crush it. The rest will come later. If you're going to be invested in stocks, you need to learn to be good at suffering, or as I like to call it, removing emotion from the process. If you're not able to remove the emotion completely, there will be some suffering. The S&P 500 has generated 783,000% return since 1928. Blows your mind. And yet, during that time, we were in a drawdown so many times. We all want more upside with less downside. But the problem is, if you try to avoid those downsides, you end up missing out on the returns. So what do? Well, first off, you build a portfolio that has exposure to asset classes that perform regardless what happens in the stock market, right? Alternative assets, real estate, private debt, private infrastructure, private equity, farmland, music royalties, those are fantastic for hedging these big swings. And also, you learn to remove emotion from the process. If you have a plan, if you trust your plan, if you trust your advisor, it becomes a lot easier to be good at suffering. A list of the wealthiest people on the planet all have one thing in common. They've concentrated all of their wealth in one company. And obviously, that company made a ton of money. It would be tempting to try to follow that strategy, right? With your portfolio, load up on one stock and hope that you get rich. My dad used to always say, you get rich with concentration and you stay rich with diversification. I'd ask you, where are you in your life cycle? If you're trying to find the one needle in the haystack, it's likely not going to end well. Studies have shown that 59% of companies underperform T-bills, which is not even close to the S&P 500. So your odds of finding that needle in the haystack are not great. Buy the haystack. Never interrupt compounding unnecessarily. When Warren Buffett turned 94, his net worth stood at $150 billion. Now, 98% of that was accumulated after he turned 65. Compounding can and will produce crazy results over a long period of time. Yeah, you're probably not going to have Warren Buffett's wealth, but even your smaller chunk that you have, if compounded, will do unbelievably if you let it compound. In August 1979, Businessweek ran a cover story citing it was the end of equities. It was over. We didn't need to invest in stocks anymore. What do you think happened? Over the next 20 years, the S&P 500 returned annualized 17.4% to its investors. Investors nowadays are bombarded more than ever before with constant noise on our phone, on our TV, in all of our streaming devices, wherever we're getting our social media news. It's tough, it's a lot, and it's constant. But remember, these media organizations, anyone who's pumping out, they're trying to do what? They're trying to get clicks. They're trying to get you to click on an article, click on something, to read something, because that's how they make money. So when you're reading anything, remember there's an angle to it, right? Tune out the noise. On any given day in the stock market, your odds of a positive return are about 53%. Slightly better than a coin flip. If you increase your time horizon to about 1 year, your odds increase to about a 75% likelihood of being ahead. And if you're looking at a 20-year period, there has never been a period in US history with negative returns. Now, why does this matter? Even if you are investing at the absolute worst time ever in the market, you're still going to be ahead long term. The key is not timing the market, the key is time in the market. Remember that. Know what you own and why you own it. You can have the best portfolio in the world, but if you don't actually understand what's in it, well, you might abandon it at the first sign of trouble, and you might fail to reap the long-term rewards from compounding. Peter Lynch once said, you need to know what you own and why you own it. Why do you have alternatives? Do you own alternatives? Do you own bonds? Do you own growth stocks and value stocks? What are the different reasons that you own ththose? You own stocks to participate in the growth and ingenuity of human beings and enterprises over time. Your goal is to outpace inflation and earn a higher rate of return than bonds. You own bonds and fixed income, likely to reduce your volatility and to generate guaranteed returns. Finally, you own alternatives because you want diversification, you want tax-efficient yield, and you want consistent, predictable income in your portfolio, which reduces the risk and provides greater risk-adjusted returns. You need to know why you own each component and how they fit together. Thanks for tuning in and taking the time to learn something valuable about investing. If you're looking to make smarter investment decisions or you'd like more personal advice tailored to your financial situation, go to speaktorob.com to book your no obligation consultation to chat about this, your portfolio, or anything else that's on your mind. It's what we do and we do it well. So remember to like, subscribe, hit the bell for more tips, and until next time, stay smart, stay invested.